Well, taxes are something most of us do not like to talk about or even think about for that matter. But since they do affect all of us, knowledge is power. Today, Cory Sickles with Safe Harbor is here to talk about some smart moves that you can make before the end of the year, especially to help lower those taxes. Good to have you back, Cory.
Nice to be here, Robin.
All right, so let's talk about one tax saving strategy, I guess, because I feel like people sometimes can get overwhelmed in this, right? They don't know really about all the ins and outs. So what is one thing that we can do?
Well, I think the first thing to do is to make sure that you're actually putting enough, enough that you into your like 401k or 403b or your thrift savings plan. Because anything you put into there, you should be able to put in at least what companies are matching you.
Right.
But whatever you do put in, it actually lowers your taxable income. So the more that you can put in there, the better. And another thing to do is kind of look where you are, because you might be able to put in a few $1,000s every year, and it might actually put you down to a lower tax bracket.
Right. Isn't that catch-up that they give some people an opportunity to do?
Yes. Once you're 50, which I am now, you can.
You say that with a little disdain, Cory. Welcome to 50.
I am now, but you can do an additional $5,000 per year.
Okay, so if you have the opportunity to do that, that's a great way.
It's a great way to lower your taxable income.
Something else a lot of people take advantage of, especially now with healthcare costs, are these health savings accounts. How does that weigh into your taxes?
Well, for an individual, you can contribute up to $3,500 per year, and for a family, you can do $7,000 per year. Again, if you max that out, put it into the $7,000, it's going to lower your taxable income by that amount. And let's face it, it grows tax-free, and we're all going to be able to, at some point, we're all going to spend money on health care.
Right, because that's what it is used for, right? It is not something you can use for anything else.
That's correct.
So you do have to kind of be aware of that. Okay, so for people over the age of 70 and a half as well, there are, you call them RMDs, these required minimum distributions. Any tax saving tips when it comes to that time? Because it's almost like you feel like you're in the game too much and you don't know how to lower your bracket. Yeah,
so one of the things that I would recommend, on a lot of our clients do this, is you can actually do what they call a charitable donation. So the money comes directly out of your IRA, the check's written to the charity of your choice.
Okay.
In most cases, the charity doesn't pay any tax, but it does fulfill your required minimum distribution, and it doesn't count as actually taxable income. So it's a good way to, if you are putting or giving money to charities, you have an IRA, it's always a good way to do that.
What about those that are invested in the market? Can you save on taxes when your money's there, kind of in flux?
Yeah, so one thing you can always do is, if you're in a 12% tax bracket, I'll just use a 12% tax bracket.
Okay.
Once you go above, if you're married above $78,000, you go into the next one. So if you actually can possibly keep yourself within the same, sell some stocks, keep yourself within the same 12% tax bracket, you actually don't pay any capital gains. So there's a potential for you to be able to sell some of the things that have gone up. The market's up about 20% this year. So it's a good way to be able to probably take some of those gains, not pay any taxes. And you can also look at possibility, maybe you invested in something that is actually, you did lose money into. You can actually even lower up to $3,000 this year. You can actually take that loss, lower your taxable income by $3,000 as well.
Oh, okay. So it works both ways, essentially. Okay, Cory, all of these we know can be used this year for savings, but what kind of advice do you have for people to plan ahead? I know that's what you're in the business of, right, is planning. So what can you do now for the years to come?
Probably the biggest thing you can do is, should I actually convert some of my IRA money to a Roth? And so one of the things we work with our clients on, and again, one of the things, if you're retired, you should try to max out your particular bracket that you're into.
Okay.
In a lot of cases. And if you are, that means you're paying the same amount of tax that you would, but now you're taking some of your IRA money, which is taxable income, and you're going to be able to convert that to a Roth, which is going to grow tax-free and you can use later on. So again, everyone's situation is different, but it's one of the things that I would really highly recommend is look at converting some of your IRA money, which lowers your required minimum distributions later, and you're going to be able to have tax-free money later on as well, because let's face it, tax rates are probably going to go up.
I was going to say, they are historically low.
Right, they're historically low. So as you go through retirement, you'll be able to save some additional money there.
All right, Cory, the last 5 minutes have just been a reason that I tell a lot of people to get professional help, because there is so much involved, as we know, in this financial world. So if you want to meet with Cory and his team from Safe Harbor Retirement, all the info up on screen. The first meeting always complimentary. Sit down with you and kind of see where you stand. So Cory, thank you so much for being here.
Thank you.